Well, welcome everybody. This is Teresa Hansen with Forum Investment Group. Thank you for joining us today. Some folks may be dialing in as we go. We'll be recording this conversation today and providing a recap following today's webinar. So we're very excited to welcome Dr. Peter Linneman with us today, who's the principal and founder of Linneman Associates, and well-respected and recognized economist. He'll be sharing with us some of his thoughts on the economy in the post-COVID sort of environment. And of course, Darren Fisk is the founder and CEO of Forum Investment Group, and he'll be leading the conversation with Dr. Linneman. So we've received some questions in advance from people, and we'll do our best to address those during today's call. If there's anything that you'd like to pose, you can submit it via questions, and we'll do our best to get to it today. So with that, welcome, and let me turn it over to Darren and Dr. Linneman. Thank you.
Thanks, Teresa, and good afternoon to most of you across the United States. Thanks for joining Forum's quarterly webinar. Very fortunate to have Peter Linneman, who is, in my mind, one of the smartest economists from a macro, micro, and then relating to real estate that I've ever met. So if you haven't already, he puts out the Linneman letter. It's got tons of knowledge, how it affects us globally and here in the US. So I'm really excited to have Peter on. Peter, just to get started, you and I have spoken a lot over, the years here, and from the 10,000, foot macro level, you've compared the exit from this pandemic to the flight of a butterfly. It's a great analogy. So do you mind walking us through that? And what does it take to get on a straight line here?
Okay, so Darren, thank you very much for having me. It's a great honor and privilege. So look, the drop back in March was precipitous. And I thought that once that we were, quote, unlocked, there'd be a pretty quick bounce, but not bounce back, not all the way back. And that's because there were still going to be huge swaths of the economy either shut down or that people didn't feel comfortable in doing. But elective medical, for example, in March, April, early May, couldn't get it. You knew that that would come back quickly, and it did. Then we had this big bounce, and there were people saying, oh, it's going to be over. This is a cyclical. And I kept saying, no, this has nothing to do with cyclical. This has to do with what governments, state, local, and federal, and around the world don't allow us to do, and what we don't allow ourselves to do related to COVID. And that's going to be in fits and starts. So in, I think, late August, early September, I said it's going to have the trajectory of a butterfly, not a V, not a swoosh, not a K, a butterfly. How's a butterfly move? Well, just think of it. Flutters around, generally forward, but sideways, not very fast, stops, can circle backwards, moves left, moves right. Yes, it's moving forward, but not very fast. And since September, that's exactly what we've had. And every piece of data you look at, Darren, you'll see good news out of the housing market. And then you'll see backwards movement out of the labor market, and decent movement out of retail, then not so great movement out of hotel. That's the butterfly. Now, what do we need to get out? Real simple math, real simple math. We've got about 50 million vaccinated to date. We have 330 million people in the US. 50 million, I'm rounding, have been vaccinated. They're doing about 1.5 million a day. Let's just assume they maintain that pace. So that's about 30 million a month. That means that over the next 3 months, we'll do another 90 million over 4 months, 120 million. So we'll be up to around 170 million vaccinated by the end of June out of 330. But remember, we've probably had 70 million had it. Now, some of that's double count. So we've got decent immunity floating around there. Children. So the way I see it, Darren, is we butterfly around a couple of 3 more months. You're going to see the numbers, I think, fall dramatically. Hospitalizations, deaths, etc., serious cases. Governments are going to open up, and you and I are going to open up. And what do I mean by you and I open up? You're going to have the shot. I'm going to have the shot. We'll go to the movie together. I have the shot. You don't have the shot. I don't know if we go to the movie together. So it's as that occurs. So, and then it's about, as that occurs, the travel, leisure, entertainment sectors start coming back. And that's the missing part of the economy. And I think the second half of the year and into next year, you see the roaring 20s. Not until then, but you see a real roaring 20s. Are you ready to go out and roar? Are you ready to go out and rip? Do you want to go travel? Do you want to go see your friends? Do you want to go to the movie? All that stuff.
Right. And as you and I have spoken about, there's the regulatory shutdown versus the I don't feel, safe to, or the regulatory open up, and I still don't feel safe to go to the movies with you.
Yep.
Peter, you've written a lot about this pandemic creating like a two-track economy, the haves and the have-nots, if you will. 85% of us, the U.S. consumers are still in good shape, but it's that 15% that have really been struggling. How are both the 15% and 85%, affecting the multifamily space and the retail space from a consumer standpoint with online and their saving?
Yeah, and the two-track, by the way, is not rich people and poor people. It's not that. It is, and I'm being broad, if you were in travel, leisure, and entertainment, I don't care if you were rich or poor, you got crushed. And obviously, if you're rich, you had more buffer to deal with getting crushed. But think of those rich rock and roll artists that were canceled their tour. They got crushed last year, right? So it's not just poor, but by the way, the gaffers who built the stage, they also got crushed. They were real middle income. And the guy who sold the popcorn, they got crushed. So it's about sector more than high, low, and middle income. By the way, if you work for Microsoft and you were an administrative assistant, you've done just fine. Same for JP Morgan, et cetera. So it's not that. Interestingly, Darren, a funny thing that people forget is that if you were on loosely defined welfare, that is government programs, you were not employed a year ago, you've on variations of government programs, you were a retiree, you may not be high income, but you have gone through this untouched, right? Because the government programs have continued. You even got the $2,000 check, then you got another check, then you got another. So they may have been low income, but they were untouched by it. Others got clobbered, just got clobbered. And that's that 15% of the economy. We don't need stimulus. That's why I'm not a big fan of the current bill. We don't need stimulus. We need relief for that 15% until the world comes back and allows them not to be victims. So it is, how's it play out for multifamily? Interestingly, that 15% has held up amazingly well through some combination of savings, government distributions to them to tide them over. And as you know, collections are off a little bit, occupancies are off a little bit, particularly in central cores of urban America, they're off more. But it's held up amazingly well in the multifamily rental space. The most notable exception is urban core. And the simplest way, I have a call after this with a client who does Manhattan and Brooklyn, and essentially a unit that had 3 people sharing the apartment and covering the rent. One of them moved back home. and the rent basically dropped 30% because of affordability. And the reason they moved back home is they didn't have a job, or they didn't have to go to work every day, et cetera, and to save some money. So the urban core has been hit the most by it. Suburbs the least.
Got it. And as far as retail sales, obviously not, depends on the state, but not too many retailers have been open. The Amazon effect, the online has been significant. How have retailers, just in general, whether it be online or bricks and mortar, held up during this pandemic? And are people saving more, saving less?
Well, there was this huge surge in March, April, May, June, tapering in July, August, September, and through today, of what I call involuntary savings. Involuntary savings. The Rockies, you had tickets for the Rockies or the Nuggets games in March, April, May, June. And by the way, you got a refund. And you had nothing you wanted to spend it on, right? What were you going to spend it on? You didn't have to drive to work every day, so you didn't have to park, or instead of eating lunch out 3 days a week, you didn't eat out lunch, so you saved the differential. Your vacation to Paris or Disney got canceled, so savings piled up. The savings rate went from about 6% on an aggregate basis in the US to 33%. It's back down to about 14% as more things have been available. How did retail, and by the way, what did people do with a lot of that savings? People who were unwilling to save to buy a home, that is for the down payment, the monthly they could make, but they were unwilling to change their lifestyle to come up with a down payment to buy a home, suddenly they had money for a down payment. You do the math on somebody with 100,000 income in their household, saving 33% instead of 6%, you build up money for a down payment for a little house pretty quickly. And so people jumped on that, and especially with low interest rates, but the down payment was the issue. Retail sales are doing okay. They did horrible in March, April, May, June, July. They've caught some of that back up. So they're up, but they're not making up for the pent up. There's still a fair amount of pent up out there. That's why I think you get a roaring 20s effect. As far as online versus not online, online versus brick, I think the whole online vis-a-vis COVID is completely backwards. You can't pick up the paper without somebody saying, oh, look, it's up 20%. It's up 20% in a year. Well, by the way, there was already a trend that it was going to go up. It rose by 3% in a year of total retail sales, not counting auto. Rose by 3%, 300 basis points of total retail sales. And you might say, isn't that amazing? So I'm going to give you a little comparison, Darren. I played reasonably competitive basketball leagues, city kind of leagues, until I was 53. And I averaged about 8 points a game. I'd like to believe that if my opponent had their hands tied behind their back, I would do more than go from averaging 8 points a game to 10 points a game. That's a 25% increase in my scoring if I did that. And in fact, if I went from 8 points a game to 10 points a game, and my opponent had their hands tied behind their back, I don't think you'd be impressed. What did online do? Online sales rose 20% while their opponent, bricks, had their hands tied behind their back. And what is impressive to me is how well bricks held out, given they were closed, distancing restrictions, entry restrictions, et cetera, et cetera. It's pretty remarkable. And what you're seeing, and what you'll see in the next few months, is online going back to trend. That doesn't mean they'll go negative, but they're going to go back to the trend line. It's not like there isn't going to be online sales. The other interesting thing about online sales is Amazon had record sales last year. You know what happened to their retail profits? They were negative. They were negative. Now, they made a lot of money on the cloud. They made a lot of money on servicing, but their retail lost money. That's a tough business where you sell everything, but you make no money.
Yeah.
And so I think the outlook for bricks on the other side takes time, but it looks much better than people think. I'm just not impressed that you could only grow 20% when your opponent had the hands tied behind their back.
Fair enough. You made a comment about the new stimulus that's being proposed. You know, there was something I read on one of your recent letters about the percentage of debt to GDP, but how do we ever get out of this, this mess
Yeah.
that we're in as far as from a fiscal,
Okay,
you look
so-
at M2 and.
Yeah. Okay. So let's take just the debt, and I'm going to make this real fast math, back of the envelope kind of math. The first CARES Act, let's just call it 2 trillion. Second CARES Act, let's call it 1. I'm rounding each one, right? So 3 trillion. Let's say we do another 2 trillion. Okay. So it's before it's all over, related just to COVID. That would be 5 trillion. That would take our total federal debt up to around 25 trillion. Okay. Now, household wealth is about 115 trillion. Household wealth is about 115 trillion. That is to say, if we decided we could retire all the federal debt and we'd still have $90 trillion. That's not so bad. Now, we'd never do that, but give you another take of it. The interest on that 5 trillion is some number like, I don't know, 50 billion a year. 50 billion. Now, that's a lot of money until you think about in 2019, so pre-COVID, the federal budget outlays were 4.3 trillion. Now, if I told you it was 4.35, you wouldn't know the difference, right? It's rounding error in the big picture. So the carry of the debt is quite small. Third, if you think about the present value of the US economy, right? Don't think of the current GDP. Current GDP is about 20 trillion. That says in 5 quarters we could pay off the outstanding debt if we wanted to. That's not bad, right? By debt standards. But more interestingly, the present value of US GDP is about 800 trillion. That is all the future, right? Discounted back to today, about 800 trillion. And we're going to borrow 5 trillion of it to tide over a generational misery all day long. All day long as that money actually alleviates pain and suffering. Now, if we borrow 5 trillion, it does nothing to alleviate pain and suffering. And that's why I say it's not about stimulus. It should be about alleviating pain and suffering. It should be about getting vaccines. It should be about getting therapy treatments. It should be making sure hospitals, it should be making sure those who don't have jobs, that lost businesses. It should be very targeted. And 5 trillion out of 800 trillion for a generational misery all day long. And the one I say, my parents were children of the Great Depression. So it's probably your great-grandparents. And would you have given 0.5% or so of your wealth so that your great-grandparents didn't have to suffer during the Great Depression? Of course. Of course. That's all we're doing. We're taking about 0.5% of future and saying to alleviate your ancestors, if you will, pain and suffering. The key is, are we using it in a way that's providing real relief from that pain and suffering, not whether we can afford it.
This dovetails into a bigger discussion, another one as it relates to cap rates, to inflation, consumer inflation versus asset inflation. So I guess, with debt so cheap right now, The 10-year was 90 basis points, say 30 days ago. Today it's at 1.4%. So we've had a tick up. So there's a lot in this question. So I'm going to dissect it for a second. Could you talk about cap rates not being tied to interest rates, but rather to capital flows?
Yeah. I'd like to believe that one of the 2 or 3 most important pieces of research I've done in my long career is a piece I did with Matt Lariva, and we published it in last Linneman, no, 2 Linneman letters ago. It follows up on something I started writing about, say, 6 years ago and did some work on, and it is cap rates are not determined by interest rates. All you have to do is look at the data. It's not there. You look at the data and there's no relationship. And you can think back, I'll give you the 2 episodes, right? In 2007, interest rates were at 5.5%. Cap rates were the same in 2007 as they were in 2019. And in 2019, interest rates were 1.5% to 2%, right? So you say, what was going on in both? It wasn't interest rates. They were totally different. What was happening in both was a lot of flow of funds, into real estate. And if I told you, assume I could promise you that a year from today, twice as much money will be chasing real estate. What's going to happen to real estate prices? It's going to go way up, because we don't have twice the supply. And I said, oh, but you didn't ask what are interest rates? It's about the flow of funds. Now, when you think about that, what happened was an enormous flow of funds, an enormous amount of funds was put into the banking system in 2009 to 2014, QE1, QE2, QE3, and it started coming out in 14, 15, 16, 17, 18, 19. It didn't come out right away. It went in, but it didn't come out. People say, oh, we had all that money and no inflation. We had no consumer price inflation to speak of. We had enormous asset price inflation. Go back to 2009 or 2010 and compare to 2019. Home prices were up, gold prices were up, silver prices were up, office prices had risen, go across the board. Stock prices had risen. We had asset inflation. And why did we have asset inflation? It's because the modern banking system is set up primarily to give money to people who buy assets, not people who buy consumer items. And so in the 70s, it was very different. We had a very fragmented banking system in the 1970s and before. And then if you look at the history of bankings, we consolidated, okay? And as a result, the banks went from effectively community banks, either big or small, to these mega money center type of banks. Those banks are not set up to give money to people to buy Wonder Bread, slices of Wonder Bread. They're set up to give to companies to buy the company that makes Wonder Bread. They're not set up to buy a bottle of Coca-Cola. They're set up to buy the company Coca-Cola. And so you had this flood of money that came out of the banks into people who buy assets. So I bought an asset from you. What did you do? Did you run out and buy a bottle of Coca-Cola? No, you went out and bought an asset. So it pumped up asset prices, left consumer prices largely unaffected. So what will happen this time? We've had huge injections of money. Again, it's not going to come out right away. My belief is it's going to come out over the next decade. I can't tell you exactly when. And when it does, it's going to chase assets and it's going to drive cap rates down. And the empirical research, as well as casual observation, says that what drives cap rates, what drives stock prices, what drives asset prices is the flow of funds. And how can cap rates go lower? I love it when people, I was one of those people. People would say, well, they can't go any lower. They can't, of course they can go lower. And it reminds me of my grandma Linneman in the 1970s. She was a German immigrant, you know, and Grandma Linneman kept saying, how can the price of bread go any higher? And I kept saying, well, Grandma, as long as they keep putting more money in the system, it'll go higher. And she said, well, won't it go down? I said, no, not unless they take the money out. So I say to a guy like you, Darren, can cap rates go lower? Yeah, as long as they keep putting lots of money in the system.
Well,
won't they fall? They won't fall unless they take the money out of the system, not just stop putting it in, but take it out. And I don't think they're going to do that. Now, they can go up and down in little bits. I'm not talking about that. I'm talking systemic. So I think you see asset price inflation, stocks, bonds, everything else over the next decade.
yeah, you know, you say something interesting. When we were building apartments in Denver in 2010, just 3-story garden style was about 100,000 a unit to build those. Today, it's about 250,000 a unit. So
And
over that,
Linneman, what would my grandma Linneman say to you? She'd say, Darren, it can't get any higher, can it?
right?
And you say, of course it can, as long as they keep pumping money into it.
Right. So, you know, and even on, you know, more of a podium product that we built for 170,000 a unit 8 years ago, that's 380,000 today.
Yeah.
In Denver. And I think this is very noteworthy. You say asset inflation with no notable consumer price inflation widens the wealth gap and effective income inequality.
Sure. Think about how that works. What inflation, go back to old-fashioned consumer inflation. Who did it help? It helped the person that already had the item, and it hurt the person who hasn't bought it yet, right? So what does asset price inflation do? Asset price inflation helps the person who's already got the asset and hurts the person who doesn't. Now, if you put a simple face on that, who doesn't have assets? Young. Right? Young. If you put a very simple, how much assets did you have in your 20s and early 30s? I don't know about you. I had none. Right? By the way, I'll be 70 next month. I have assets simply because I worked and saved and worked and saved and worked and saved. Right? So what it did was effectively say that if you were a saver and you were older and a saver, we're not talking about Bill Gates here. I'm talking about real normal people. I'm not talking about billionaires. I'm talking about real normal people. If you were a saver and you were older and you would save with some regularity, you didn't have to be a senior citizen, asset price inflation benefited you. It raised the price of your home. It raised the price of your stock portfolio. Yes, there were ups and downs, but it raised them, right? Who did it hurt? Well, I don't have any assets. And I'm trying to chase those assets and buy a home, or I'm trying to build a 401k portfolio, but instead of being able to buy 12 pieces of stock, I can only buy 8 because of the asset price inflation. And what that did was take the younger and the non-savers and put them at greater disadvantage versus the older and savers. Now you can put other faces on it, but that's the simplest face. And by the way, I got, as an asset owner, I didn't get hurt by consumer price inflation. So my home went up in value, right? But bread was still pretty cheap.
Right.
It wasn't like my home went up in value, but bread costs a lot, right? So if you had the asset, you kind of won. And I think you're setting it up again. We're setting it up again for a similar pattern
Over the next decade. You know, rewind 10 years ago after the great financial crisis, you know, a majority of our returns had come from cash flow. As returns have gotten lower and lower, you look at where retail was 8 years ago to where it is today with the Amazon, the online shopping, there are less and less opportunities globally, not to mention in real estate with, you know, multifamily and industrial are the two, you know, bells of the ball right now. You know, we keep talking or hearing about distressed hotels or I haven't seen it. And like you showed in one of your charts, these banks have enormous reserves, and they're saying, hey, forbearance. Willie Walker, who we met with, he said of his $74 billion in loan servicing, not one loan, they're the number one largest Fannie and Freddie lender, is not in forbearance today. And moving forward, I'm sitting here saying, okay, cap rates are going down, current income's going down, but I, like you, am such a big believer that we're going to see asset inflation as costs continue to go up for multifamily. The flow of money comes into multifamily. But you also made a point earlier about banks. Banks are going to concentrate their lending disproportionately to where their capital wants to go. And it's not to consumer goods, it's to hard assets.
Right. And if you think about it, the way they got massive reserves was a gift from the Fed, right? If QE1, QE2, QE3, and now QE infinity gave them massive reserves. Those massive reserves, unlike in the 60s and the 70s and the 80s and the 90s and the early 2000s, those massive reserves said, if somebody doesn't pay you, you don't have to worry about having enough regulatory reserves. You got tons of regulatory reserves. Forbear, forbear, forbear. That's what we gave you the money for. We didn't give you the money so you are a hard guy and you foreclose on Darren and you foreclose on Peter. And then what you do is lend to Peter to buy Darren's old asset and lend to Darren to buy Peter's old asset. We don't want to just play musical chairs. If Darren's a bad guy, foreclose on him because he's a bad guy, not because a bad borrower, right? Foreclose on Peter because he's a bad borrower, but not because of this. Forbear, forbear, forbear. And what you've seen is bank enormous forbearance, not just in real estate, on all their clients, enormous forbearance unless you're a bad borrower. That is, they didn't like you before all this started. They were trying to get rid of you. And that's forbear, forbear, forbear. There are two flies in that ointment. One is non-bank lenders don't have the luxury of endless injections from the Fed, and they've had to wrestle much more so with forbear or not forbear. And the second is bank or non-bank, if you have negative operating income, truly negative operating income, and you have to feed the beast. Because it's one thing for a lender to forbear, and it's another thing for them to feed the beast negative operating income and let you keep your equity ownership. And so you're going to see stuff there. But by and large, it's been a forbearance, for almost everywhere. And the main bankruptcies you've seen in America are either that restaurant that truly went out of business, right? They just truly went out of business. Or they were some borrower, corporate, that had big bonds. They had a lot of bonds. And the bonds aren't a bank. And forbearance was much more difficult. They had to go to Chapter 11 to renegotiate with them. But the banks, not been an issue. And I don't think they're going to be much of an issue moving forward. There'll be some bad borrowers, but very, very different phenomena than in the past.
Got it. So Willie Walker has spoken to our audience, and I listened to his podcast, and you were on one of them at the beginning of the year. You had mentioned that we're entering the golden age for multifamily real estate investing. Yeah. In layman's terms, what does that mean for our audience?
Okay, so I think the golden age is, and I think it's narrowed a little, as you'll see. I just did math. And again, we wrote about this in Linneman letter, I think last issue or something, and we set up a little model to show people. You tell me, I'm going to do existing more or less stabilized product, right? I buy at a 4.5 cap, right? Nothing special. Now, if I'm on the coast, that's special, but across America, I can buy a 4.5 cap in a lot of places. Agree? What could I finance that at? Especially if you go back a month ago. A month ago, I could finance that with Freddie or Fannie for 10 to 12 years at what? 2.3, 2.4.
Yep.
And I think I could still do it today for about 2.8, 2.9.
Yeah,
You'd
so
agree?
3%.
Yep. So you do the cash flow on a 4.5 cap, borrowing 70% of the money at 2.8, 2.9. You cash flow big. You have big interest coverage. You have decent debt coverage. Even if income falls, you're not going to lose the property. And by the way, income goes up a couple of percent a year, and you have cash on cash. You almost can't miss doing a 9 IRR over a 10 or 12-year hold. And you're more likely to do on simple math, right, that I just went through, up to 15, 16%. But where can you get in your career? How often can you get 9% almost assured on the downside, and as much as 15% pretty comfortably on the upside by just running an apartment building? Nothing special, no big cap rate, no big, right? That's a golden age. And by the way, you're not going to lose it on a downturn because the interest coverage is so high that you're not going to.
Right. As I like to say, housing is a necessity in life. You have to have a roof over your head. You can shop from home, you can work from home, but a roof over your head is a necessity.
So I'll just do one last point there. Normally, over my career, if you borrow 70%, 80%, what would I, on a stabilized product, forget the cap rate, on a stabilized product, you'd say interest coverage somewhere between 1.05 and 1.25. Agreed? Roughly?
Yeah, the lenders would underwrite to debt service of a 1.2, let's say, right?
Right. At the interest rates, especially the interest rates of a month ago, but even so, the interest rates of today, your interest coverage is like 1.8, 1.9. That's got to be a golden age. And it's not so much golden because of the fundamentals of apartment demand. It's the golden age because of the capital market dimension, which I don't know how long it lasts, but as long as it lasts, it's golden. Now, by the way, I'm not negative on the supply demand of apartments, but what makes it golden is not the supply demand part, it's the capital market overlaying good supply and demand.
Got it. So during COVID, I got quite a few friends, family members, business folks that have moved, states. They say, hey, look, we're moving. It's kind of a reset in life. 2 questions here. 1, do you think those moves are permanent? And 2, how does the multifamily supply and demand get affected by that?
By and large, I do not think it's permanent. Now, if somebody was 78 years old or 73 years old, and they were already thinking about, do I move to Boulder? That could be permanent, but that permanent probably would have happened anyway sometime in the next year or 2, right? So in that sense, it was more a matter of timing than it actually occurring, right? All the rest of it is, it's a little like, I'm not a terribly political person. And over the years, Democrats have told me, if that person is elected, I'm leaving the country. I'm leaving the country. And I've had Republicans tell me, if that person is elected, I'm leaving the country. And you know how many I've seen actually leave the country in those cases? Not many. And that's because it's a good place. There's a reason to be here. There's a lot of plus. And that's how I kind of view the answer to your question. Most people are in a place that from a work, life, social, amenity, family serves them. And what happened during this period is the amenity part disappeared. I can't see my family. So what's the point of being near them? Other than I can Zoom, right? I can't go to the ball game. So what's the difference whether I live in a city that has sports or doesn't have sports? I can't go to a concert. What's the difference of living in a city that has concerts versus a city that doesn't? So I think a lot of it happened from this temporary elimination of the amenity of a lot of places. People said, well, I'm out of here. And I think there's a reason people were there in the first place. I mean, there's a reason they were there. Those are coming, will come back. I mean, you know, I'm struck by the example of Berlin. World War II and the Soviets could not destroy Berlin. Yes, it took some time, but the combination of World War II and the Soviets couldn't destroy Berlin. I just don't think this will. And I take Berlin because it's such a dramatic example.
So about 2 years ago, Forum, made the switch, to really focus on this renter, or from the renter by choice to really this renter by necessity. You talked about the urban core, whether it be in Manhattan, we're here in Denver. I grew up in the Bay Area, and the amount of people moving out of San Francisco to the suburbs, going to Marin or going out towards Sacramento. Is it likely that we're going to see this trend continue, post-pandemic, or will there be a flock back to the urban core, and will this demand remain static? Where do you see that playing out?
It will revert. It's like a scale. Imagine, the scales, the old-fashioned scales where you put, and these urban cores had a whole bunch of negatives, right? Traffic, bad politicians, crime higher. So they had a whole bunch of things on that side of the scale that made it unattractive. But on the other side, they had theater, ballparks, concerts, close access to your friends, etc. And that was the balancing. What happened during this? One side stayed the same, and the other side you saw everything come off of. And renters in particular, and high income people, could make that quick transition, that very quick transition. But what happens when you start putting amenities back on that scale? It's going to balance back up. Now, it's not going to happen overnight. It'll take a couple of years. But as you put stuff back on the scale, on the amenity side, it will make it balance out much more so. And I just don't think, I think people lack imagination, Darren. I think people lack imagination to see beyond what's currently happening. And it's as simple if I told you you have this scale and I took everything off. By the way, what's the flip of that? Suppose I told you you have this scale, negatives and positives, and I took all the negatives. Schools were suddenly wonderful in the cities, no crime, taxes are low, government officials are not corrupt and easy to deal with. What would happen to the cities? You'd have an enormous inflow, right? Because you took all the negatives off. Well, we saw the opposite of that. We left all the negatives on, but took most all the positives off. Well, of course, that created an imbalance. Those positives will come back. It'll balance back through.
I agree with that, but will challenge or maybe disagree in one sense. That's assuming that, when you think about the urban core and the cost to build what we call type 1 construction, steel and concrete, is so high. I think you're at the top of the pyramid as far as rents go to be in those urban cores versus, as you said, and we talked about this inequality gap. I think that missing middle class, what we define as somebody that makes $35,000 to, let's say, $80,000, it could be firefighter, a policeman, a school teacher, et cetera. They're not going to be able to afford potentially to go back into the urban core. And the cost to build new is so much significantly higher than the suburbs.
Yeah, but that was true a year ago, right? If we had been doing this call right before the shutdown, everything you just said was true, right? Everything you just said was true about the problem for the policeman, the fireman, the school teacher. All that was true a year ago. And yet, right? And yet you could build and, you'd do okay. That's all I'm saying. I'm not saying the city is perfect. Don't misunderstand. I'm not saying it doesn't have problems with high costs, government officials can't get out of their way, crime, congestion. I'm just, there's other things on the scale to make it worthwhile, right? And we're going to go back to having more of those other things. Right now, it's ridiculous, right? Right now, it's all the negatives and none of the positives. So the positives will come back on. And I think you're right. The people that it's a biggest struggle for, exactly the people you described, exactly the people you described. And in the near term, they might be able to afford the city again for a while. They might actually be able to afford it.
Right. And net operating incomes are off, 20% in San Francisco right now. It does, beg another question for, that income inequality in the low end of apartments, say C class, where they don't own any assets, and how the appreciation, or if they're not seeing wage inflation at the low end, like the middle or upper class
Right.
is, how that will be affected as well.
Yeah, I mean, look, for those people, and there's two types that fit the description you gave. One are temporarily where you said, namely, think of us when we came out of college or when we were in college, right? We had no skills. We thought we were talented, but we were no assets, not a lot of income. And we grew out of that, right? And what people forget is, you hear this number about the 1%. The 1% changes. You and I were, at least I wasn't close to the 1% for the first half of my life or more, right? And by the way, from 18 to 32, I'm in the bottom. And you grow out. I'm not saying everybody. The ones who will grow from, making $10 an hour to $20 an hour over their life, they're the ones who will be lifetime renters. They'll never be able, most of them, to assemble a down payment. That's their big problem, right? They can do a monthly, but they can't do the down payment because they can't save enough on that income. That's the bigger challenge, and it's what keeps those apartments you said active, right? Is that they can never assemble a down payment. Right. They can never. Realistically, you're making $30,000 a year. You're living by yourself. You're the only earner. And you have 2 children. How do you assemble a down payment, even for $100,000 home? Right. They're a lifetime renter. And by the way, they go from making $30,000 to $40,000 over the next decade. They still are not going to be able to assemble much of a down payment. Those are lifetime renters, and our obligation is to make sure that they have safe, decent, quality housing available to them.
So that leads into we have about 10 minutes left to our last few questions here that I have for you. How is the multifamily supply and demand dynamic shaping up? And are there any particular markets that look attractive or risky in your research?
The most risky in the near term are the urban cores. I'm just doing these off the top of my head. The urban core of Denver, the urban core of Nashville, or the urban core of Charlotte, and that's because they were darlings. And as you were talking about the cost of construction of that product, that podium type of product or high-rise product, it was expensive product that needed high rents. And people got out ahead. We could have had this conversation a year ago before COVID, and I think we would have both said, market's probably a year and a half ahead of itself in those products. Not 10 years ahead of itself, but a year and a half ahead of itself in a number of those markets. Well, those markets got that product, but they didn't get the demand because of the scale phenomenon we were talking about, the balancing scale. So right now they're probably 2 years, 2.5 years off balance. They need the scales to rebalance. They need this new supply to stop. New supply is stopping in those locations. So markets work. And as the scales come back, they'll do okay. I've always tended to like suburban markets. They're not sexy. I tend to like just grind it out, right? Just grind it out. Suburbs always grow faster than the cities. More people grew up in the suburbs than they grew up in the cities, and therefore that's where they want to live. Not everybody can afford shishi products. Some can. I think the challenge, though, is the urban core product for the next 2 years, not forever. Just, it was a little ahead of itself, and then COVID put it an extra year or so ahead of itself.
Getting a little overbuilt in the urban core.
And then obviously the New York fringe stuff, right? The pushing Brooklyn a little farther, pushing into Queens, those same, it's not urban core, but it is urban core, right? Same discussion.
What's your feeling on acquisitions of multifamily versus development and the spread differentials on returns? I've studied this a lot because we do both, but I'm really curious as to your take.
Okay, so I used to I covered this in my classes years and years, and I would start out by saying, my wife and I, by choice, have no children, no biological children. However, my wife and I have, not through adoption, but through love, if you will, by real close attachment, 5 or 6 children. Really, they call us mom and dad or mom and dad number 2 or whatever, right? And I would say to the students, you know, you can either have a child or get one later like that, right? And I said, I'm not up to the risk of a child. I chose to do it once I saw the product a bit and so forth. The challenges you know about development is when everything goes right, you earn your money and then some, right? You really do. If everything goes smoothly, no contractor problems, no escalation in costs, demands on time, no crazy politicians slowing you down, no community group, you earn more return than you deserve. You'd agree? The problem is when any, much less all of those happen, you just get crushed. You just get crushed. And my view personally is, thank God there are developers, because thank God there are parents. We need children, right? But I don't know that I have to do it myself. I just don't know. So I've been involved in developments. It's a rough go. I mean, it can be a rough go. And the problem is when it goes well, you forget the problem child, right? It's a challenge, right? So obviously there's been a lot of people who have made a lot of money through development. There's no doubt. But it's not for the faint of heart, right?
Yeah, I would say it a little different as banks have deleveraged the days of 90%, financing that led up to the last downturn, where Wachovia would provide you 90%, yeah, and they didn't get paid for taking that equity risk. Today, you're getting a 60% loan. So managing that, I will tell you, from Forum standpoint, if we can build to say a 5 3/4 to 6% return, unleveraged return, yep, and it's worth that 4 cap or sub 4 cap today,
then that's a big margin. That's a big
and there's
margin.
A huge margin, and maybe one of the largest margins I've ever seen between what we can build to at 6 and what we can finance to, say, at 2 3/4 or 3, versus an acquisition. And I'm not saying it's either or; it can be both and. You sure don't potentially have as much value creation in as quick of a period of time. But with an acquisition, if you're buying at a 4 cap, and just so people know, nobody that I know today is amortizing their loan. because that 3% loan, when you start amortizing, your effective rate is essentially in the 4. So you have negative leverage, if you will, and you have a really wide margin or very narrow margin on the acquisition as more capital, as you pointed out, is moving into this space. So
I think there are two risks of development. There are two ways to view the risk of development right now. One of the problems, there are obviously offsetting virtues. One of the problems is right now, you can walk into Fannie or Freddie and get, what did we say, a 2.8% loan on an existing product, right? You know that. You know it 100%. When you develop, you think that in 2 years, you'll be able to convert your construction loan into a Fannie and Freddie at 2.8. You don't know it. And that is a risk given how advantageous financing appears. That's a risk that is not normally there. The other thing that I always point out, it's not as true with suburban product, but I do the following math, and developers think I'm some type of sleight of hand artist. And I said, well, think of a podium product. Just 3 years, is that about right? From when you start to when you stabilize, 3 years for a podium, just roughly, right? I'm not doing high rise. So 3 years. So you have your choice, unlevered. I'm going to do unlevered. One, I could buy at a 4.5 cap, okay? And for 3 years, I would get 4.5, which means at the end on 100, right? So it means that at the end of 3 years, I've collected 13.5, right? 3 times 4.5. I've collected 13.5. Now, alternatively, I could put my money in and develop. Remember, I'm doing unleveraged, so we aren't going to get hung up and refinance and so forth. I get 0, 0, 0. So at the end of 3 years, I'm 13.5 behind, right? So if I pick up 200 basis points spread on my development, right? In the way you were saying, a 4 versus a 6 or a 4.5. So I pick up 200 basis points. I basically have to pick up 200 basis points for 7 years to make up for the fact I'm behind on the initial 13.5. You follow what I'm saying that way?
100%.
And what it means is when, excuse me, when people say, I'm doing this for my kids, in an odd way, it's true, right? Because for the first 10 years, I would have been, quote, better off, cash flow, to have bought. And it's only after 10 years, the 3 a building and the 7 to catch up, that I'm, quote, better off. And that's a very simplistic way to look at it. And obviously financing gets involved and so forth, but it's a very simplistic way to highlight the advantage and the disadvantage. The advantage comes really from the years after. That's where you really created the value. And the disadvantage comes from the years of 0 when you fell behind. And it's how far behind did I fall versus how much do I catch up and how long does it take me to cross over?
Right. And so one of the reasons why we switched specifically from doing, urban or podium type product is all of a sudden you got 300 units and voila, you got to lease it up. When we do garden style, we're delivering in month 12 our first 3 24 unit buildings and our clubhouse, and we're getting income after 12 months versus waiting 3 years. So
by the way, you're right. So take the math I just did. If you could actually, I buy it at 4.5 and you do the development the way we said, and it takes a year and a half, let's say, to stabilize from when you start. Okay, I got 6, 4.5, and then, half of the next year, let's call it 6.5. So you're behind at the end of a year and a half by 6, but you're only behind by 6. You're not behind by 13.5. That's a big, big difference. And you're still catching up the 2 every year. So basically you catch up in 3 years. So if you can get the product done fast, put aside cost escalations and all that, you change that crossover point dramatically sooner.
And
By
I'm
the way, take the extreme. The other way, high rise, not just podium. Now you're talking what, 4 to 5 years?
right.
Now I'm behind 5 years of 4.5%, right? And I'm like 22 behind, 23 behind. How long? It takes me another 10 or 12 years to catch up. It's not until like year 15 I've got the crossover. So high rise versus suburban garden.
And that's assuming no price inflation, which we already talked about, which has been
Correct.
Well, Peter, look, it's just after 12:30 our time. I cannot thank you enough. I love having the dialogue. I hope our guests today did as well. If they don't already have your newsletter, it's something that I read every time it comes out. So thanks so much for being a participant today, and wish you well the rest of the week. Take care.
And I must thank you for one thing. You're in recognition for my doing what is actually fun. You have made a very nice contribution to my education charity, which is Save a Mind Elimu, which means education in Swahili, which helps really destitute children education in rural Kenya. So I appreciate, thank you very
We're
kind.
happy to support you. We do that as a company, and happy to do it. So thanks again for everything, Peter.
My great, thank you. Have a great day.
You too.
Thanks, everyone. We'll be doing a recap and sending that around following today's conversation. So thanks very much, everybody. Have a good day.